We just have a quick question here from Sneer. Now, Sneer's asking, how often is there events with very high volatility risk? So, as always, thanks for the question. And the answer is actually more often than most retail traders realize. So, there is, of course, a difference we can make, or distinction we can make, between scheduled events and unscheduled events. So arguably, any major economic data point or central bank rate decision has the potential to be a very high volatility risk event. But of course, by now you know that the event itself will only have a high volatility risk if it is a highly anticipated event, especially if the market is uncertain about the outcome. So an example of this can be think of a central bank rate decision where money markets are pricing in only a 50% chance of a rate move. So half of the market thinks there's going to be a cut and half of the market thinks the bank will stay on hold. Those are always going to be massively high in terms of volatility risk. But any highly anticipated major economic data point like growth numbers, employment numbers, CPI numbers, if it is highly anticipated, does carry that inherent risk of volatility, higher volatility. Then turning to unscheduled events, also coming across the wires on a weekly basis, they are often always going to carry a little bit more volatility risk. And the reason, of course, is because the markets doesn't know that it's going to happen ahead of time, right? So think of a tweet from a president, or an unscheduled comment from a central banker, or OPEC coming out saying something, or massive geopolitical developments happening. No, it's not a scheduled event; it's unscheduled, so we never know that's going to happen. So these type of things always carry with them that inherent risk of volatility because they are unknown. So it often causes the market's expectations to change, which often sees a big jump in volatility as we need to see markets reprice for that particular event. So when it comes to other major things, like things like global recessions, like the global financial crisis back in 2009, or the coronavirus market crash we had March 2020, these events obviously carry the largest volatility risk of all events. But luckily for us, these type of events don't happen that frequently, because they can be tricky to navigate and trade. So if we go to a weekly chart like this one on some of the volatility instruments like VIX or OVX, for example, we can just see these events that cause these massive types of volatility bombs and these blowouts. Luckily, it's not too frequent that they happen in the market. They happen every couple of years, depending, of course, on the type of situation at the time. So, for example, back in 2009, we had the global financial crisis. Back in 2011 and 2012, we had the sovereign debt crisis. So you can basically pinpoint all of these major occurrences for these volatility blowouts. But again, luckily, they don't happen that frequently or that often. So the main ones that we can obviously always just focus on is the normal running of the mill events that occurs, whether it's unscheduled or scheduled on a weekly basis, and they do happen quite frequently. It's difficult to put a number on it, saying that it happens twice a week or it happens 3 times a week. It really does depend on the expectations at the time. It depends on the market sentiment at the time, on the anticipation, etc. But they do happen, I'll say, on a weekly basis. At least one event during that week will be a big market move in terms of volatility risk, whether that's a scheduled or an unscheduled event.